Shit, I wasn't even. Okay, so leave a comment, and I could explain further. Oh, this is good. We could see. So I'm just showing you how rebalancing works and how one stock can really become a huge part of your portfolio. Because Berkshire Hathaway, so in 2013, this is Berkshire Hathaway's top 20 holdings. You could see Wells Fargo was the number one holding, 21% of its portfolio. And its portfolio is worth $100 billion. And then you have Coca-Cola was number two. You see Coca-Cola moves up or down. He might buy or sell Coca-Cola. Also, the price of Coca-Cola may go up or down. And you can see DE, Deere and Company, John Deere. Now we're in 2015. So this is moving by quarter because Kraft Heinz, he's looks like he's buying a lot of Kraft Heinz. Every time he buys or sells, he has to report that in his 13F SEC filing. You don't have to report every single buy or sell, but when it's a certain number of shares or a certain percentage of the company, you are required to report it. Like even if you or me or a regular investor, if we bought 5% of a company, which obviously we can't afford that, but say we did, or 10, I think it might be 10% is the rule. We have to report that to the SEC, and the SEC has to make that public so anybody can see. Victor, what's up? Is this the website you were talking to me about? Investor Holdings. It's called valuecider.com, and it shows you how the stocks move by quarter over time. Because anytime someone buys a lot of a certain percentage of a company, they have to report that with the SEC. And so we can go to Berkshire's website or the SEC website and see what they buy and sell, because legally they have to report that. When we buy or sell a stock, it's such a small percentage of the company, we don't have to report that to anybody. But when a big company does, they have to report it. That's how we find out all this information. Now you can see, let's just see, when did they start buying Apple? Here's 2017. I thought it was in 2017. Maybe it's 2018. Oh, here it is, 2017. So Apple, you can see, is 18, 19, 20% of their portfolio. You can see how much it's moving up. He might not have bought any Apple even in 2018. I think he did buy some, but it's possible he didn't buy any more Apple, but it's still going up as a percent of his portfolio because the price of Apple is going up so dramatically. Here's 2019. Oh, let's change the speed so it goes faster. 2020, it's almost 50% of his portfolio is Apple. 2021, Bank of America, number 2, Amex, number 3. Here's Chevron, 40. Look at that, 50, 23. At one point, it was a little over 50%. Now it's coming down because he sold off some Apple, right? Did anybody hear me in the beginning when I first streamed? Were you able to hear me? I think I forgot to put my my sound on. So stupid. But let me just show you an example, like an extreme example. And I'm not taking actual numbers. I'm just kind of estimating just to show you what I mean. Sheesh. This is how portfolio rebalancing works. I can hear you. Okay, good. This is how it worked in his portfolio and other people too. But let's say in 2017, this is your portfolio. It's Apple. You always buy 100 shares, and say it was $12. I'm not sure what it was. Just this is just an example. So the value of your Apple is $1,200, and you buy 6 other tickers, whatever you want to call them, um, and you always buy 100 shares. That's just your thing, and that's how much money the value of each one is. So the total portfolio is $12,000. 10% is Apple, because 1,200 over 11,900. It's not 10%. It's 10 point, but it's rounding. Now, say 5 years later, say you don't even touch your portfolio. 5 years later, so you don't actually buy or sell any Apple. The price of Apple, and look, they did 2 stock splits. Oh no, one, because 2014 was before 20. So they did a 4-for-1. So now you have 400 shares of Apple, and let's just pretend it's $77 a share. And let's just pretend everything went up. It didn't even go down. So that went to 22, that went to 8, that went to 16, that went to 24, that went to 16, that went to 35. Let me fix the formulas here. So in 2022, you didn't actually, so 5 years later, you didn't buy or sell anything. You kept this portfolio exactly the same. And your Apple went from 10% of your portfolio to 72% of your portfolio. And everything went up in price. It's just Apple went up so much relative. Okay, yeah. So I think initially I didn't have the sound on, but it seems like I do the same thing all the time. But I know a lot of people who this happened with them too. They bought Apple. That seems to be the main culprit, Apple, and they didn't even add any Apple to their portfolio, but it just became such a large portion. They might have even added other stock. Let's just pretend you see these 100 shares. Let's pretend we added 50 shares to each one. And we didn't even buy more Apple, it just split. That's why there's 400 shares. So we actually spent money on these other stocks. We didn't even spend any more money on Apple. There was the initial $200, and still Apple's 63% of our portfolio. It's 2022. What you should do is I'd buy more Apple, ride it out. The trend is your friend. But this is how our portfolio managers do it. This is why I don't like portfolio managers or going with those types of funds. That's why me and Victor are going to do our own thing. What they would do in this case, because you ever hear the term, we need to rebalance our portfolio. Because they can't have one ticker that's more than like 20% of the portfolio. That might be like a rule in their prospectus or their whatever rules they made up when they started the fund. They say 20% max for one ticker, or it could be, and then 40% max for one ETF. So an ETF could be 30% of your portfolio, but it can't be more than 40% of your portfolio. So what they would do in this case, because Apple they're in breach of their rules, so they would sell off Apple. So they may, instead of the 400 shares, they would sell 300 and bring it down to 100 shares. So say by 2025, now you have 100 shares, but the stock still goes up a lot in price. It goes up 50%. But when you sell off the Apple, you have to buy other stock. Or you could sit in cash, I guess. You have to buy other stock. So then you put into these tickers, which I'm not saying is the worst strategy in the world. Obviously, because if Apple goes down a lot, you'd be happy you sold off Apple. But in this, and for Apple or those really good companies, I wish I would have just did my original strategy. Because I remember when I started one of my retirement accounts, I put it all into Facebook. It wasn't Meta at the time; it was Facebook, and it was like 2014 or 15. I mean, I didn't have that much money at the time, so I was like, okay, I'm putting all 30,000 into Facebook, and I'm saying, and I said, all the money I get. It was just in my retirement account, not in every single. I had my brokerage account where I had other investments, and of course I have cash and things like that. So I said, all the money I get, I'm just going to dedicate to Facebook in this retirement account. And then these stupid experts, Kramer, people like that, they got in my head, and they're like, they give you all these examples like where people worked at Enron and they had their retirement at Enron and they lost all their money. So it gets in your head, and they're like, you got to diversify. So I'm like, okay. So I ended up not doing my strategy. But if I did my strategy, I could have retired when I was 40 or even 35. But if I would have kept just doing my Facebook thing. But you live and learn, right? That's what they say. But you only live so long. Like, at what point are we gonna be able to stop learning and just because what if you're 85 years old? Just keep learning. You'll be dead. So what's there to learn? So we gotta we need to see results, right? And mistakes are fine, they say, because then you don't make the same mistake. But if we're getting, I mean, I feel like I'm not super old, but I'm getting up there, right? I don't want to keep learning and making mistakes. I want to start seeing real results. But anyways, this website's pretty cool. Let's go back to it before I get sidetracked. So it's valuestarter.com. And then you could go into each of the super investor portfolios. And you could even look at its particular stocks. Like if, say you're into Google, which is a good stock to be into, you can look at the history of Google for these big investors. So in 2015, we'll just do the top 5. Let's do top 10. So in 2015, there was only 3 super investors that owned Google. David Rolfe at Wedgewood Partners, 4% of his portfolio was Google. Ravenel Boykin, under 2%, and Thomas Russo, only 0.01%. So let's play it, and you can see it changes each quarter. Here's Q4 2015, Q1 2016, and you can see whether people are buying or selling Google. David Jeffries, the biggest. He owns 14% of the company. It's interesting, right? Because what a great time to buy Google, 2015. I mean, Google in 2000 was like took over the market in terms of search engine. I remember search engine Google started becoming a little popular in early 2000s. There was other search engines like Mozilla, AOL, Yahoo that were the main sources. Then Google just like quashed everybody. But even in 2015, which is well like 10 plus years after Google was popular, so it wasn't like an unknown company, but you could have made 20x return just back in 2015, from 2015 to 2025. You could have made an amazing return. And Mark Massey, 26% of his portfolio, and this is 2020. So this is the COVID bottom. So 6.3 billion, 6.8 billion. That's how much money these super investors have in Google. Now we're in 2021. Eric Schoenstein, and you probably don't know a lot of these names, and neither do I, but these people manage really big portfolios, the biggest in the world. But you don't see Berkshire on this list. He didn't buy Google. Now we're in 2023. Li Lu, 18% of Li Lu's portfolio. Bill Ackman, he's popular. I've known him for a while. Robert Torre. Li Lu. So now we're in current time, first quarter 2025. So this is the top holders of Google. These are just for the super investors, not for everybody. Because if you have a $10,000 portfolio, right, and $9,000 of your portfolio is Google, that means 90% of your portfolio is Google. You'd be on this list. It would say 90%, but you're not on this list. These are the top 100, something like that, 100 funds out there in the world. So you can look at Li Lu Himalaya Capital Management. And if you want to look at Himalaya Capital Management, everything in their portfolio, they only have 8 stocks. Diversification is for suckers. I wish I never learned about diversification. David Tepper is performing the best. So that's good to know. These are kind of things, who's doing the best, who's someone you want to follow. So for this particular investor, Li Lu, 26% of his portfolio is in B of A, 22% Berkshire. See, they're all winners, right? Apple is the smallest, 1%. But as long as you pick winners, you'll probably make money. You might pick a loser or two, which is fine. But that's why sometimes diversifying is just wasting your time. Honestly, I wish I never, I can't go back 20 years. I wish I would have just stuck to my guns. But it's just so easy to say in hindsight. Occidental Petroleum, we know Warren is really big on them. But it's because Occidental Petroleum, his investing is a little different than yours. Like, he doesn't always just buy equity. He does own equity in a lot of these companies, but he has a lot of preferred stock in Occidental Petroleum. So he's getting like an 8 or 10% dividend, like a guaranteed dividend for some of these investments. Let's see if we can find it. Occidental. Because when he invests in a company, like if he buys 10% of a company, they may give him like like a little like teaser, or here's 10 million shares of preferred stock, or here are some options. We're just going to give it to you because you're putting so much money into the company. So he's getting kind of like more on top of his investment, and you don't get that. So it's hard to like compare yourself to like here, Occidental started paying off Berkshire's 8% preferred stock. So like if you buy equity in a company, you buy 50 shares, they're not going to give you anything for buying 50 shares. They don't really care about that. But when someone like Warren buys it, they're going to give him a little bonus. Does that make sense? It's kind of like if you go to Starbucks, right? And like say you get a $5 coffee every day at Starbucks. And then say instead of going to Starbucks, you go to like this like ABC coffee store. It's just in your town, right? And it's in the same shopping center as Starbucks. And the coffees are both good. So when you go to ABC, they give you like every fifth coffee they give you for free because they appreciate your business because they don't get as much business at Starbucks. So they give you a little extra, or they'll give you a little discount here and there, or they'll give you, they'll throw in an extra shot. So it's just like a little teaser, and it gets you to go to ABC more, and it makes you feel good. And sometimes you'll end up spending more money at ABC. Like say same thing, $5 a coffee, but every week they give you like a one free coffee, but you end up buying like snacks also from ABC when they give you the free coffee, or you give them more of a tip. So you don't even save money sometimes, but it's just that little teaser. It makes you feel good. That's kind of like what happens with Warren. He gets these like preferred stock on top of his equity. So it is hard to compare. So that's why. So if you buy these shares, like if you bought Occidental when he bought it, it might be flat because I think it hasn't been going up that much, but he's getting 8% off the top. Look at this. I mean, Buffett has steadily increased his stake in Occidental Petroleum since 2022. Okay, in 2019, he invested $10 billion in preferred stock with an 8% annual dividend. So he's getting a guaranteed 8%. He's locked in at that 8%. And he's $10 billion is a lot of money. Because like if you have a $100,000 portfolio and you invest $5,000 in Occidental, that's 5% of your portfolio. But if you put $50,000, that's half your portfolio. And if you're getting this guaranteed return on top of if the equity goes up, it's like, so that's why it's a little different. They have to report 13F publicly when the fund value is over some threshold. Right. That's what I said in the beginning. So how's Udemy looking? So anybody that okay. That's how we find out who buys and sells stock. Even if you buy a stock, but you buy like 10% of a company, you have to report it to SEC. It's like 1 million shares or 10% of the company. 13F filings. Yeah. When do you have to file 13F? What is the threshold? Okay, the SEC's 13F must be filed quarterly by institutional investment managers with at least 100 million assets under management. So if you have 100 million or more of assets under management, then you have to file Form 13F. So it's how much is in your portfolio. So pretty much, obviously, Berkshire has well over 100 million. They have 250 billion. So anything they buy or sell, they're going to have to report the 13F. And this is good information because if somebody, a big fund like Berkshire or Bill Ackman, if they're buying a stock, you want to know about it, right? So they have to make that public to make it fair for everybody. And a lot of people don't even look at that stuff. I mean, I don't look at that. I mean, I can't sit there on the SEC website all day, refreshing it, looking for updates. But it's good for you to, if you can, go to the SEC website and see who's buying or selling stock, because if you see somebody buy stock like a Bill Ackman buy a lot of a company's stock, that doesn't mean the company is doing better, but it's a signal to the market. And then other people start buying the stock and it starts going up a lot in price. But you don't want to wait for like a news website like CNN or Yahoo Finance to let everyone know about. It might be, maybe yesterday Bill Ackman filed with 13F, right? And today a news website tells everybody about it, and then everybody starts buying it. But if you went to the SEC website yourself and saw it, and then you bought it before everybody else, then you get the stock for like $15 a share instead of 25, because the stock went up so much because everybody found out about it because of the Yahoo Finance story. If that makes sense, because it's not like when there's a story on a big website like Yahoo Finance, then other news sources start reporting it, or people like me. I make a YouTube video, or any YouTuber. They make a video. They talk about things like this. Which I do sometimes too. I'll just go to the website. Oh, look at this Sunrun, up 15%. Here's an article about a new contract. But if you wait, like a lot of people do, they wait to hear about it from a different source. It's already well past the point of you buying it. But that's what happens. Like that's when people buy stock, is after everybody in the world talks about it. Like Nvidia, you don't want to wait for everybody to talk about it, and it's already a $3 trillion market cap company. Maybe if only a handful of people start talking about it and it's a $1 trillion market cap, maybe start buying it. But if you wait for everybody in the world to buy it, like most people do, you already missed the boat big time. It's all publicly available information. It's not like only certain people have access to SEC filings. And you don't even have to go to the SEC website. I mean, you could. That's a good source to go to. You can go to if you're looking at Apple, for instance, you go to Apple's website. Especially a company like Apple, if that's the stock you're following, you go to just type in Apple Investor Relations, any ticker, and type in the word Investor Relations, and then it brings up their website, and it's right here, SEC filings. So you click on that, and then you could search Apple's filings with the SEC. It's linked to the SEC website. Or you can go straight to the source. And you go SEC. I mean, it's not that straightforward, because then you don't even know what to look for half the time. It's like searching for a needle in a haystack. But it's like anything. You just do it enough. Like in the beginning, I'll read here's the latest article, May 22nd. notification filed by National Security Exchange to report the removal from listing or registration of matured, redeemed, or retired securities, which I don't even know what the hell that means. Like, what securities are they talking about? So you just open it up, and then doesn't really give you much info. Pursuant to the requirements of the SEC, NASDAQ certifies that it's reasonable grounds to believe that it meets all. So it might be just like some bond or some debt they issued. So I don't even know what the hell that is, but the next one is an 8K report. So on May 12th, Apple issued $1.5 billion of notes at a 4% interest rate due in 2028. Well, it's pretty common for a company to issue debt, especially when debt is due. They'll issue new debt to pay the old debt. So this is not a big deal, but if you were looking at a small cap company, right, a company that's not as big, this could move the needle. Like if a company like a 5 billion market cap company issued $1.5 billion of notes, that's pretty bad. Issuing debt is really bad if you're a small company that's not profitable. It's kind of like if you're a successful business person, right, and you want to buy another business, then you could get some debt. You buy another business because you have other businesses that are profitable. But if you're struggling, like you can't even pay your mortgage, right? And then you have to go to another bank or another loan company to get like a $10,000 loan just to pay your monthly bills. That's a big deal because you're getting closer and closer to bankruptcy. So generally, debt is a good tool to scale and grow if you have the funds to pay it back. But if you're not making money, it's kind of like a last resort kind of thing. But this is stuff you learn as you do it. Like you might not have thought of that, but I've done this a bunch, so you just learn as you go. But like if it was a small cap company, so not a lot of people are reading, like everybody's reading Apple. All the big news sites are reading Apple's SEC filing so they can talk about things in their news report. But if it's a small cap company, not a lot of people. So give me an example of, I'll show you what I mean. A small cap. It doesn't have to be a tiny company. It could even be a mid cap company. But a small cap company, I mean, this is real small, 1 million. Let's look at the top gainers for the day. I'll show you what I mean. A Circle. We did a video on Circle. So let's do Circle because Circle Internet Group, 28 billion market cap. So it's not a huge company, but it's a decent size. Unfortunately, a lot of people are following Circle. This is not like an unknown company. But what's a company? Okay, Enliven Therapeutics. Not many people are following Enliven, ELVN. I mean, it's a good strategy. This is what Warren did when he was younger. He didn't go to SC. There was no website to go to. He would actually have to pull the actual physical paper, and it would take time to get it. But this is how you kind of like not have to figure out how to use the SEC website. Let's see. How do I search? Oh, company search. Okay. ELVN. Okay, Enliven Therapeutics. So not many people if you do the correct due diligence. And there's obviously only so much time you have in a day. You can't spend, you can't, for 1,000 companies, you can't do this type of research. But if it's a few companies you're looking at, so right here on June 13th, which is today, right? June 13th, they added securities to Form S3. So there's a pretty big information that obviously the stock went up 17% because of this. So then if you could have found this out before, the masses did, and this is still not a big news story, but it's significant enough to move the stock. So let's see, pursuant to Form SS3, 3, okay, they're offering 40 million. 40 million is a small number, but this is a small company. $40 million of shares of common stock. The par value, remember, the par value is 0.001, has nothing to do with the value of the stock. Every single share has a par value tied to it. So usually it's like a penny or a tenth of a penny. So it has nothing to do with the value of the company, of the stock. Even Apple stock has par value of maybe 1/10 of a penny. It's just a way to track the number of shares in the market. Shares of the company preferred stock depository. So they're issuing a lot. Warrants. So they're issuing not only common stock, preferred stock, warrants. Warrants are long dated options. Preferred stock, debt securities, subscription rights to purchase common stock, preferred stock, purchase contracts of companies. So did they IPO today? Is that what this is? Enliven. Let's Enliven announces pricing of public offering of common stock and pre-funded warrants. I don't think they IPO'd. I think they just did an offering. Right. Yeah, they've been around since 2021 or so, 2020. And you could see it was $32 a share. It was $2 in 2022. So it was really low. It's up 14% today because of this offering. So it looks like they're just issuing more securities. It's just a way to raise capital, to fund growth, maybe an acquisition. Yeah, so I'm not sure how much money they raised. I guess we won't know maybe until the required opinion and consent additional securities. Yeah, I'm not sure how much money they raised from this offering. But why did it go up 17% just by issuing? What is it? Berkshire gets a tax benefit on the Oxy dividends because they own such a high percentage of the companies. It's taxed like international free cash flow or something. I don't know. I never heard that before. That they get a tax benefit because they own a lot of stock. Why would it be up on a dilution? That's what I was thinking last half. I'm trying to understand why it would be up. Because a lot of times it's hard for us to even know, like, why is it up? Like, what's the benefit? prospectus. We could look at their prospectus. So it looks like a $200 million offering. What's the market cap? Okay, 1.1 billion. So I mean, it's pretty. 200 million is like 20, almost 20%. So that's a pretty big percent of the company they're offering. 200 million. But this is how you learn it. This is how let's try to figure it out. We're offering 200 million shares of common stock in lieu of common stock to investors that so choose, pre-funded warrants to purchase up to X shares of common stock. And even if you're like an analyst and you have a ton of experience, it still might be confusing. So sometimes you have to piece things together. And the best way to figure it out is just to Google Enliven stock price, and then maybe you'll see a news article explaining why the stock is up. Okay, so this is why it's up, which I think they're starting to talk about right here in the. I think that they've made a breakthrough. We are on a clinical stage. We are a clinical stage biopharma. The document should say what they're going to do with the money. Obviously, you're not going to tell them every single thing you're going to do with the money, but generally, why do you need the money? And usually, it's for an acquisition, or it's for some type of funding strategy, or to pay debt, or a combination. Okay, so Enliven announced the public offering of 8 million shares of common stock at $20 per share. So it's over 20 now. And pre-funded warrants. The gross proceeds, $200 million before deducting expenses. The offering is set to close June 16th, which is Monday. The company is granted underwriters 30-day option to purchase up to 1.5 million shares. But that's what the underwriters do. The underwriters buy the stock. So that's how this keeps the market fluid and moving. The underwriters actually buy the stock for whatever price it is, and then they sell it to us. Like, we don't buy the stock directly from the company. It's like these big funds do, like Goldman Sachs or Jefferies will buy the shares, and then they would sell the shares to us for a big price increase. But it still doesn't say why it's up. Right, Enliven secures $200 million through stock offering to bolster clinical pipeline development. Dilutive, but strengthens financial position. This financing strengthens the balance sheet, providing crucial capital for advancing its small molecule therapeutic pipeline through clinical development stages. So they're getting closer and closer to monetizing the products they're developing. So they just need more funds. So it's kind of like say you want to sell EVs, right? And you designed a patent and you figured out a way to manufacture EVs. You have a little nuance to it, so it's a little more efficient than Tesla, right? So say you raise $200 million, and say you're at say it's like 4 stages to developing a car. You broke it up into 4 stages. Stage 1 to the design part and to figure it out, the research. The final stage is actually manufacturing the vehicle. So say you already passed stage 1, 2, and 3. So you did all the R&D, and then you built the factory, but you just need another 100 million to actually make the cars. And once you make the cars, then you could start selling them for $30,000 each or $40,000 each, and then recoup the money that was already put into the company. So you just need that last 100 million. So if that's the case, investors are willing to put up 100 million because they know once you start selling the cars, the stock will shoot way up. Missiles are being launched from Iran. So if a company said we need 200 million to pay back a loan, right? The stock wouldn't be up at all. It would actually probably be down. But in this case, but this kind of thing I wouldn't invest in. I think you're probably going to lose money because it's not like a sure bet kind of thing. Because even if they do, let's see, they should mention in the prospectus what they're going to do with the money. 1 minute. But this is a good process. Kind of learning, because once you do it once or twice. So let's see. These are the sections. Okay, about this prospectus summary, risk factors, forward-looking statements, the use of proceeds. Here it is. Okay. We will set forth in the prospectus supplement our intended use for the net proceeds received from sale of securities. we will retain broad discretion over the use of the net proceeds to us from the sale of securities under this prospectus. Pending our use of the net proceeds from the sale of our securities, we intend to invest the proceeds in short and intermediate investment grade interest-bearing securities. So in the short term, when they get $200 million, they're not going to just sit in cash, because they want to earn at least a couple of percent interest on it. So they're just going to put it into like T-bonds or something really liquid, which is common. I wouldn't think that's a bad thing. I wouldn't worry about that. But that doesn't really tell us what they're going to do with the money. That's not really helpful. The following description of our securities registered under Section 12 of the exchange is intended as summary only, as not a complete description. The description is based upon Delaware General Corporate, you should research authorized capital. You know that they don't make it easy, do they? They just said that we're just gonna put it into short-term. Is that it? Use of proceeds. Okay, here, this section. What the hell was the other section? Yeah, this is page S18. What were we looking up for? Oh, this is the table of contents. This is just a summary of the sections. So the full section. Here's another kind of summary. Okay, here's the full section on use of proceeds. So so this is important. This is how you can identify whether stock will probably go up or down, is how they're going to use the money. Okay, so we estimate the net proceeds. So they can't put in the net proceeds because they don't know what it's going to be, but we know it's going to be roughly 180 million, because 200 million minus fees. Because they don't know how many shares the underwriters will exercise and how many, all the discounts and all the fees, but we know roughly what it is. Okay. Missiles are being launched from Iran. Now I know that. There's a lot to talk about. We'll talk about that in a little bit. Okay, so we currently intend to use the proceeds with our existing cash to fund ongoing research and development activities, including a planned phase 3. So that's a big deal, because we know in order to get a drug to the last stage, to get a drug monetized where you can sell and market it, you have to complete phase 3. Phases of FDA trials. So on a high level, where's a good let's see if University of Cincinnati. I'm looking for just a chart. I just want to give you just a sense on the process. Okay. So if you develop a drug, there's 3 phases you have to pass. So each phase takes time and money. So that's why it's so expensive. Certain drugs, it could take a decade to develop a drug that becomes available to people like me and you, and it could take hundreds of millions of dollars potentially, because first you have to obviously develop the drugs, figure out the right ingredients of the drug, and that takes time and money. and then you have to go through phase one, where you have to get a number of people to test the drug on. And this says 15 to 50 patients, and then you test the drug and you get the feedback from those patients. How do they feel? If somebody dies from a drug, you want to find that out beforehand. Obviously, you don't want anybody to die, but you probably wouldn't give someone a lot of a drug to get to that point. If you gave them a certain amount of the drug and they became very ill, then it's too much. You have to pull back and give less. So you test it on a certain number of patients. You have to do a lot of reporting, provide a lot of information to the FDA based on the clinical trials. There's actually a phase 0 before this, so we're just going to assume you passed phase 0. You test a drug on a number of people. You provide all the testing to the FDA, and they may or may not approve you. If they do approve past phase 1, then you go to phase 2. And it's similar in the respect of testing. That's pretty much what you're doing each phase. You're testing. So now you're going to test on a larger population of people. So maybe in the first phase, you only tested it on white females. Now you're going to test it on Black females, or you probably want to get a wide group of people: males, females, Black, white, different cultures, because some drugs affect, like a Black female has a different reaction to a certain drug than a white male, or an older person has a certain reaction to a drug than a younger person. So you have to test on a lot of different types of people, not just ethnicity, but age, gender, and you have to, the potency of each, you have to maybe test a higher potency because you want to find out the negative side effects. So it's a very time-consuming process. But if you get to phase 3, that's a big deal. Like, not a lot of drugs get to phase 3. But by getting to phase 3, you're really close to the point of monetizing it and being able to manufacture it and sell it. Because phase 3, you compare the new treatment to existing treatment. So you compare it to another drug, you compare it to a placebo. Phase 4 is treatments approved and available, long-term effects are observed. So phase 4 is kind of like, it's already out there in the public, and people are using it, but it's still being tested because you want to find out, like, is a drug, because sometimes it's hard to know if something works until it's used on a wider scale. That's why if you've ever worked at a company and they develop a new program, right, or an upgraded version of a program you're currently using, right, and they do as much testing as, but you don't really find out and then people ask, we did all this testing, how come you didn't fix this bug during testing? Because it's just hard to look for every single bug, because you don't even know what you're looking for half the time. So that's kind of like so once you pass phase 3, you're golden. You can even one drug can make your company $1 billion company. It has to be a pretty popular drug that's used by a lot of people. So yeah, so this is why the stock is up pretty much. They're using the funds because they're in phase 3 of ELVN-001, and are also working capital. And you can also look at, that's really the I mean, this is how you do real deep due diligence. And even when I try to go to this level, I'm not an expert on like these types of drugs, so I just have to kind of take the company's word for it. But you learn each time you do it. So it talks about we're in clinical stage biopharmaceutical company focused on development small molecule inhibitors to help patients with cancer not only live longer but better. We are currently advancing 2 parallel lead product candidates, ELVN1 and 2, as well as pursuing several additional research stage opportunities with our development approach. Okay, our first product candidate, 001, is a potent, highly selective small molecule kinase inhibitor designed to specifically target the breakpoint cluster region, Abelson gene fusion, oncogenic. This is why, like, I have no idea what this stuff is. It sounds good to me, right? It sounds like they're moving in the right direction for patients with chronic myeloid leukemia. So that's the reason. So these factors prolong treatment course, off-target toxicities, and acquired resistance remain significant unmet need for an effective and more tolerable treatment. In our preclinical studies, I was looking for dollars. Where is that dollar amount? Okay. Okay. Here it is. So exceeding 6 billion of sales, and why there remains significant unmet need for tolerable. So 6 billion of sales, is that, I guess that's what they're saying this drug can generate. Because you see this company is pre-revenue. They have no revenue. So we know now how to do a DCF. So we could run that 6 billion through our DCF and get a sense what the stock price is worth. Trying to think, what time do I have to go to work? So 6 billion of revenue. I would think a company like this can generate, I'm going to assume a revenue is still 0 in year 1, and let's say they're on target with 6 billion. And I would think they can convert 20% of that to free cash flow. Up to free, because this is so 6 billion. No, so 6 billion, just a 6 is the correct thing, because everything's in billions. Let's try the most conservative. Okay, so it's valued. Let's see what's it trading at. $22 a share, 1.1 billion market cap. So this is how I would do it. Let's assume they hit the 6 billion of revenue, and they convert 10% of that to free cash flow in year 3. I'll just assume they have 0 revenue in year 1, year 2, year 3, they hit the 6 billion, convert 10%, which means 600 million of free cash flow in year 3. I give them a higher whack because I think it's a bit risky. Even on a very conservative basis, I'm at $80 a share. It's trading at 22. So, but that's 6 billion. I'm gonna go lower because I think 6 billion is too aggressive. I'm gonna go 4 billion in year 2, 5 billion in year 3. It's still, let's do 3-4 billion, because 6 billion, who knows if they'll hit it. Even if they get half the 6 billion by year 2, I'm still at $60 a share. So it seems like a good value. But like I said, chances are it may not. It's gonna probably come down in price, because it's not like they're making any more money, right? They haven't even sold anything, so it's gonna take another year or so to start selling and to get to the point when they can monetize the drug. If they do, it could be a home run. But that's the thing with these types of companies. Like if it was a company that's already making a product, like a Tesla, and they just needed more money to build another factory, I'd feel a lot more comfortable than a company that hasn't generated any revenue. But that's the risk you take. Leukemia is very pervasive, and effective treatment would be extremely valuable. Our failure rate is really high. That's why I was trying to get to earlier. That's why drugs are so expensive, because you're not just paying, like a drug is like, it may cost $2,000 a month for your drug, right? And then you have insurance, thank God. So now it goes from 2,000 down to, like, you just have to pay your copay, your $100. So, which still seems like a lot of money, like $100 a month. But if you didn't have the copay, like say you just had say you had a crappy insurance, you might have to pay $400 a month for the for your medicine, which seems like a lot, right? But you're not paying for. That's the thing. When you buy when you pay for medicine, you're paying for all the failed medicines that company had the past 20, 30 years. So this one, like this one drug, if it does pass phase 3, there's 10 other drugs that this company tried to develop that didn't pass phase 3, that failed in phase 1 or phase 2, or never even gotten to phase 1. So you're not only paying for this drug, you're paying for all those failures, because they have to recoup all that money they spent. But yeah, but this is kind of like the process to kind of look at it and learn about a company. And I mean, I'm not sure if I even got any closer to figuring out if it's a good buy or sell. I'm just doing the best I can do with the information I have. I mean, if I worked in the industry, right, and I actually worked on drugs like this, and I was part of the process, I probably would have a lot more insight, and it would make more sense to me, and then I can make a better decision, and I could say, this would never work, even if, and like I might say, gene fusion, no, that there's no way that it should be that way, it should be this way. Kind of like if I look at the financials now, do they even have financials? Which they don't. it's kind of like if I looked at the financials of the company, which is there's nothing really to look at because it's a zero revenue. I can like give some insight into it and saying like, oh, their operating expenses are so high relative to their zero revenue, or or I could say, oh, operating expenses have not increased that much relative to prior years, and then have a little more insight. But it's just when you learn it, look into any company, you can't be an expert in everything. Like Buffett is an expert in insurance. It took him a while to get to that stage, but I don't know. Did you guys benefit from that process? Did it make sense? Going through that example? So this is today. So Circle is up 20% today. It's crazy, right? How much stock has moved? And Livin, we just looked at. Solar Edge, Sunrun. What a crappy company Sunrun is. Darling Ingredients, Restoration Hardware. Voyager is up 8%. Oracle still doing well at 7%. Yeah, Larry Ellison got a big payday. That's just the trend is your friend. So from April, it doubled. So in 2 months, it doubled in price. It's up 100%. But I mean, Oracle for a while, it wasn't really moving that much. It had a modest growth from 2010 to 2020, and a lot of other tech companies were growing faster. But they've done really well. I wanted to buy into Oracle. I just didn't know the right time. Because they peaked in 2000, like Intel. Intel peaked in 2000. It was 43. So for 20 years, it didn't really move from 2000 to 2020. And it's crushing it now. Intel is just garbage, right? It still hasn't recovered. You can see the peak in 2020. It hasn't even gotten to that level again. It's actually down 70% since 2020. I mean 2000. It did make a decent run up, but now it's come back down. So would you guys invest in Intel? Like, I don't know. Because now when the stock's going down, it's so easy to say, I wouldn't invest in Intel. It was it's a waste of money. But Nvidia was like, remember when Nvidia they had that big run up in 2024, and then it came down a lot in the beginning of this year. So it looked like it was going to keep regressing. AMO, Lam, ASML. I like Taiwan Semi also. I think that's my favorite, my go-to. But hope you like the stream. I'm trying to do more streams. Figuring out different things to do. But yeah, okay. Thanks for joining. I have to go to work in a little bit. Sheesh. Okay, talk to you later.